Good morning and welcome to Financial Accounting. As we look at our calendar, just a reminder that exam 2 was due yesterday. I'll talk a little bit about that today once we get started. The project should also have been submitted over the weekend. If you have not yet submitted that though, the Dropbox is still open. I did hear that there was an issue with the SEC website, so if you did not figure out where else to find that information, you can still submit that project. No problem with that. Today we're going to be finishing up Chapter 7. So the Chapter 7 exercises should be submitted for grading by the end of the day. And then on Wednesday, we will be looking at Chapter 8. So the Chapter 8 pre-quiz and the Chapter 7 problem should be submitted on Wednesday. As I said in that announcement that I sent out, I think it was Friday that I sent out the announcement about the drop-in review session. I'm going to try doing this each week as one more support for this class. So each week I will find a time to schedule that. I'm not stuck on them being on Fridays, although that did seem to be a good balance with class on Monday, Wednesday. I don't care which day or what time it is. So if there are people who would like to attend this drop-in review session and just can't do Friday mornings, if there's another day that's better for you, another time that's better for you, you just need to tell me that. Hey, I'd really like to come. Could we try having it on a Thursday or whatever? My schedule is pretty flexible other than this time, 9 to 10 a.m., 10:40 a.m. Monday through Thursday. So I'm willing to try it wherever would be most beneficial for the most people. The idea of this drop-in review session is that it's not an extra class, but that it would give you extra time to work on the assignments or work on the concepts with me there as a support. So as I said in the announcement, my thought is that we could work on the chapter problems, that we could work on the practice exercises for the exams. I can put together an extra set of exercises. Of course, it would be optional, but I'm happy to do whatever people think would be most beneficial, but you need to tell me what that is if you plan to attend. I also will plan to record the sessions and make those recordings available on YouTube as I do for class. So, and I'll post an announcement after each session saying, here's what we talked about, and the link is now available. So I hope to see some people take advantage of that. The exam grades were kind of across the board. There weren't any that were, super, super low. We did have some really, really nice grades in the mid to upper 90s, 90%. So that was good to see. But there were also a significant number that were just barely passing or just below passing. So for people who were in that category, kind of the DF category, you will have seen an announcement come, or not an announcement, excuse me, a message, an email come from me through Starfish that says, I'm concerned here about your grade. Here are the things you can do. There is not anyone for whom it's too late. We have 3 more exams. And as I was discussing with someone earlier, the exams are only 50% of your grade. So even if you were to keep doing the work at the level that you're doing, you could still pass the class. But my concern isn't really ultimately your grade. My concern is, did you learn what you're supposed to learn from accounting class? So I made some suggestions. If you got one of those emails from me, I made some suggestions about what you might consider doing to improve your grade. One of them is to, if possible, attend these review sessions and let me know in advance what you would like to do at those sessions, what would be most beneficial for you. If you are still unsure about the earliest chapters, chapters 1, 2, and 3, if you didn't do well on that section of the course, we might need to build those skills. Starting with chapter 6 and on, each chapter is somewhat independent. So they're all built on that original foundation, the first few chapters. But from this point forward, if you didn't really understand or didn't do well with the inventory chapter in chapter 6, that won't affect how you do in chapter 7, 8, 9, and so on. So, but if you didn't do well in chapters 1, 2, and 3, and you're still kind of lost on those concepts, then we should start there. We should start with building those skills. So as I said, the drop-in session on Friday this week can be on any other day next week. Actually, it can't be on Friday next week. I'm booked all day. So if you can attend those review sessions, that would be a good place to start. The other two suggestions I made were seeing me during office hours. Of course, as always, you can request a time that's not official office hours. I'm happy to accommodate those, afternoon or whatever other appointments, times you might need. And the third option that I suggested is there is a tutor for this class. And I don't know if there's more than one. I just know for sure there's at least one. If everyone tries to sign up with the tutor, that there probably won't be enough time slots for everybody. And so that will work up to a point. The way you would sign up for any one of these, my office hours, as long as it's within my posted office hours, the drop-in review session, and or a tutor, all of that will happen in Starfish. And I can't really show you exactly how to do it because I don't have, get to Starfish here. But if you're in Starfish, I can't show it to you at all. There it is. If you go to the section called courses, now I'm not going to see anything here because I'm not registered for any courses, but if you go here, you should see a kind of a box for each one of your courses. And if you look at the box for this class, BUS 1510, you should see me, and under me, you should see the link for the drop-in review session that you can sign up for that. And you also should see a link right there for the tutor for this class. So those are my recommendations. If you're not happy with your grade, if you are happy with your grade, if you got a 65 and you're happy with that, that's fine, right? A 60% average in the course is passing. And as I said, the exams are just half of your total grade. So it is not the end of the world. It doesn't mean automatic failure if you are not doing well on the exams. I would still like to see you do better. And so I would encourage you to figure out how to make that happen using any combination of those three things or whatever else you think might be beneficial. Let me know how I can help. Okay. Any questions about that? Okay. So for those of you who did well on the exam, congratulations, keep up the good work. And if you're not happy with how you did, figure out what you're going to do differently and let me know how I can help with that, whatever you decide. Thinking about the exam then, I wanted to bring to your attention, there's one question that someone in the online class asked about already. She went over her exam and saw that there was a question. The question was exercise 6.230, 230. And the question did not, excuse me, the question did not say to round. And so this student did not round her answer. She put her answer in dollars and cents, and it was exactly correct. And the software marked it wrong because she hadn't rounded, but the question didn't say to round. So I am going through everybody's exam. I did not have time to do that this morning. So I started in the online class because that's where it was brought to my attention, but it will take me a little bit of time to get through. I have to pull up each person's exam and look at that question, find that question, and look at how you did it. So some of you may see your exam grade go up. Of course, nobody's going to see it go down, but some of you may possibly see your grade go up if you had the correct answer but did not round because it didn't say to round. So if you see your grade change, that's why. Other than that, review on the exams is open. I would recommend that you review that, see what you missed, why you missed it. Is it a test taking issue that you maybe could use some help with your test taking skills, how to avoid test anxiety, how to more efficiently take a test. The Learning Center frequently offers workshops related to that kind of skill, and they would also, I imagine, help you one-on-one if that's what you need. If it is a question that you, for example, one thing I frequently hear is that I had the right answer, but then I changed it. I should have just left it. When I used to give exams, paper and pencil or pen, whatever, in the classroom, it's surprising how often I would see that, because if someone's turning in an exam, I can see that you had one answer marked and then crossed it out or erased it and put something else. I hear that pretty regularly. Oh, I had the right answer, and then I second guessed myself. So, the trick there is do not change the answer unless you are 100% sure, like you found your error, you had a math error or something like that. Other than that, generally you want to go with your first guess as the best, your first answer, I shouldn't say guess, the first answer as your best answer, unless you are 100% sure that you made a faulty decision the first time. So I would ask you that you go through the exam. Just as with exam 1, I am very happy to go through with you any questions as you look at your exam and you say, oh, I missed that, but I don't understand why it's wrong. I'm very happy to go through anything. I would be happy to go through the entire exam with you if that's what would be beneficial. But I can't do that in the classroom. I can't do it on the recording. So, because that's not fair to everybody. So just ask, make an appointment with me, or if you don't see a time in Starfish that works for you, just ask for a different time. I'm happy to help with that. Anything else you want to talk about before we turn our attention back to chapter 7? All right. Well, let's go to chapter 7 then. In class last week, on Wednesday, we started chapter 7. Of course, that was not on the exam. Chapter 7, the title of the chapter is Internal Control and Cash. And so we spent the entire last class talking about the internal control piece. And today our focus will be on the cash part. As I told you last week, the internal control part is more conceptual. We talked about the history of internal controls as far as how we got to where we are now with the requirement for compliance and reporting on the effectiveness of your internal controls. And then the auditor's duty, which is new in the last 20 years, new duty of reporting on how effective they believe your internal controls are. So that did not happen prior to Sarbanes-Oxley. So we spent a lot of time talking about what internal controls are. There's a great deal of information in the book that we are not covering in class, although I am always happy to answer questions about it. But we spent an entire class period mostly just talking, mostly it was me talking about the internal control structure. So I don't feel the need to add any more to that unless you have questions. But you definitely want to read in the book about the control environment, and all of the factors associated with that internal control structure within the company. And as I said, if you do have questions, you are certainly welcome and encouraged to ask those during class or outside of class if you feel more comfortable with that. If there's a question you want me to address in class, but you don't want to ask it, just send me an email and say, could you talk about this in class? And I'll be happy to do that. But are there any questions now that you want to ask about the internal control history and other information that we discussed on Wednesday of last week? So mostly on your own, you should have completed or should complete exercises 1, 2, 3, and 5. We did a little bit of that together in class, but mostly I asked you to complete those on your own. And today, when we get started, our first exercise is going to be exercise 4 in the chapter 7 exercises. And then we will skip exercise 5 and go to exercise 6 and finish up the chapter. So what is cash? Well, when we talk about, and I mentioned this in class last week, when you look at your companies that you chose for your project, when you look at their balance sheet, I would almost guarantee that the first line, the first current asset on their balance sheet doesn't just say cash like we've been calling it since chapter 1. It almost certainly says cash and cash equivalents. So we need to talk about what is a cash equivalent. Why are they lumping these things together? Isn't it, it's either cash or it's not, right? Well, we don't look at it necessarily that way from an accounting standpoint, that there are other assets that the company may have that they might as well be cash. That's what we mean by a cash equivalent. And there are 2 requirements in order for something to be considered a cash equivalent. It has to be relatively liquid. So we've used that term liquid before. It refers to how close something is to being cash. And when we say it's relatively liquid, we want it to be turning into cash within 3 months, or by the time we prepare the next quarterly financial statement. So 90 days, 3 months, we want it to turn into cash if it's not cash now. And we want it to be in a relatively risk-free investment, if you want to think of it. By relatively risk-free, we mean that it is insured usually by the federal government, or that it is issued by the government. So relatively risk-free and liquid. Turn back into cash within 90 days and is either in something like a money market, a CD, a government bond that has a maturity of less than 90 days. We would call that a cash equivalent. And on our balance sheet, we would lump it right in with the cash, because what we're saying is, it might as well be cash. It's close enough to cash. We're not afraid of losing it. There's no risk attached to it. It's not a volatile investment like in the stock market, where yes, we could sell the stock to get the cash, but we might take a loss when we did that. That would not be acceptable as a cash equivalent. We focus on cash. The reason, as I told you last class, the reason that the title of this chapter is Internal Control and Cash, because cash, as you can see in the bottom, the last bullet on this slide, cash is our most vulnerable asset. So if internal controls are designed to protect the assets of the company, then cash is going to be the primary concern. It's the most easily stolen. Second most, we said last class, the other thing we really need to concern ourselves with is inventory. That's also very stealable, very much subject to potential fraud or theft. So the money could be cash on hand. It could be instruments that are given to us by our customers, such as checks, money orders. But it also could be money sitting in the bank where we can, in economics, we would call that a checkable deposit. So we can write a check against it and immediately access that cash. I can change my slide here. So how are we going to protect that cash? Well, we need to make sure that we are accurately accounting for it. We want to have multiple sets of hands on that cash. So we talked about last class, the question of, if you work in a grocery store or something where you have a cash drawer, who's responsible for counting that and maintaining the integrity of that chain of custody, so to speak. So we need to be careful that we are accurately accounting for any cash that's coming into or going out from our business. Last class, we had looked at an exercise that, I can't remember the exact scenario, but the woman was a new manager. I think it was a coffee shop or something like that. And one of the statements in the exercise was the cash drawer has to come out to the penny every single time. And I said, to me, that's a concern. That's a red flag, because it just doesn't happen that your cash register is going to come out to the penny every single time. And so how do we account for that when we have sales that, we run a report from the cash register, it says how much our sales were, and the cash that's in the register does not exactly match that. Well, our first exercise today is going to be, how do we deal with that? And it's by using an account called cash short and over. And so we'll see in that first exercise how do we do that when the cash and the sales report, the revenues don't exactly match. So I usually like to show you the visual, because for some people this is an easier way of thinking about something. So we know that cash is changing hands at that cash register. The cash register is one system of control, because we are ringing up that sale, and we have an accurate, we hope, an accurate report of what ought to be in there. We've already talked about the cashing the cash drawer out, who handles that, whether it's a manager, whether you as the person who's responsible for that cash drawer, do you sit there and watch them? Do you count it yourself and they count it? Who runs the report? Is it the same person that counts the register? The accounting department, of course, is going to be part of that control operation. The accounting department is going to record the revenue and the cash receipts. The cash is then going to be put into a deposit that is going to be transferred to the bank. And so the bank acts as another step in this control process. And it might be our very next exercise. Our very next exercise after we talk about cash short and over, we'll be doing a bank reconciliation. So we'll be talking about how the bank acts as a check and balance for us to make sure that we are accurately depositing that cash as well. So as I said, our first exercise is going to be related to the cash short and over account. And we already discussed where that would come from, that the change is not made correctly, or someone drops a quarter into the belt at the cash register and the cashier just says, don't worry about it, or you're penny short, or you give an extra penny or whatever. All of that can add up. And if you are seeing dozens of customers during a shift, if there were, a 10-cent error on each one, that can add up into significant dollars. I don't mean material amounts, but amounts that need to be recorded. As I said last class, most people who are in accounting are the kind of person who wants it to be to the penny, and you're going to be concerned if it's off even by a penny. It doesn't mean it's something that we consider material. It does not mean that it's something that you as the cashier would get in trouble for, get written up or something like that at work. So many employers might have a limit on how much you can be short or over without raising a red flag or causing a concern. I've been able to gather stories from students over the years, and what I typically hear is if there's an amount that's set, it's usually $3 to $5 you can be short or over without it being something that results in maybe a warning or a written notice or anything like that. So and this is just an example, I'm going to talk about this example just so you can see what this looks like, and then we'll go to our first exercise. So what do we see in this journal entry? Well, we reported our revenues. This is our revenues right here. This is our sales. Where does this number come from? Well, we ran a report from the cash register of how many sales were rung up through that register. And it was $35,690. But the cash, and I'm assuming this is a summary entry, not just one cash register for one shift, but the summary entry, the cash that was in the drawers was only $35,668. So the cash part, get my arrow here. So the cash part here must be the exact amount that is being deposited or being taken out of, counted from the drawers. And the sales part needs to match what the report from the register said was sold. The cash short and over then is how we account for any difference. And most of the time there will be a difference between the revenues report and the actual cash. The difference could be that we need a debit to make it balance. That is, the cash is less than the total sales. Or it could be that the cash is more than the total sales, and we would then need a credit over here to make this entry balance. The amount that we are going to debit or credit to the cash short and over is whatever amount we need to make the debits and the credits be equal for this transaction, for this journal entry. Again, it could be a debit, it could be a credit. It's whatever we need to make this balance. And then at the end of the accounting period, so maybe this is for one day. Yeah, so this says this is for May 3rd. So at the end of the month, we're going to have this cash short and over that we've been putting debits and credits and debits and credits into this account. And at the end of the month, we look at how much is left in there. So some of those shorts are going to be canceling out some of the overs. And at the end of the month, we look at what's left in that account. And then typically we would report it as a miscellaneous expense if it has a debit balance at the end of the month. Or if it has a credit balance, we treat it as other income. So it is almost certainly going to be an immaterial amount. It's not going to be a major amount in that account. It better not be. If it was a material amount, that's where we would get concerned. As I said, each company certainly has the right to set an amount that they deem to be, if it's over $3 or if it's over $5, that's where there's a concern. So let's go to our exercise. Any questions about what we've just said here, though? You understand why there might be a difference between the cash that's collected and the revenues that are reported. Okay. So let's go to exercise 4 in chapter 7. I'll give you a moment in case you're not there. As I said, the debit to cash will need to be exactly the cash that is being deposited, that was received. And the credit to revenues or sales will need to match up. We need to have support for that, which the documentation is the report that's run from our cash registers or whatever system it is we use for recording those sales. So the sales credit is always going to be, what did the sales report say we sold? And the debit to cash is always going to be the amount that we actually received, that we removed from the drawers and deposited in the bank. Those two numbers are precise. They need to match exactly what we have documentation to support. And then we look at the difference here. So right now the credit, the sales is higher than the cash that we received. And so it's going to be a debit to make these two balance, and they are off by $28. The difference between the cash received and the sales report is $28, and we need to debit that account. So if you're a business, which one are you more concerned with? Are you concerned that the cash is short or that the sales are lower than cash? What do you think? If you are the business, I'm not saying there's really not a right or wrong answer. I have an opinion about which one is more important. But if you were this company and the sales report says you sold $28 more than the cash you actually had in the drawers, which would be more concerning to you? Having too much cash or too little cash? Too little? There isn't a wrong answer. So if you're concerned about being too little, is it, I don't want to put words in your mouth, but is it because you're afraid that someone may have stolen it? That, yeah, it's gone because someone, pocketed $5 here or $2 there, quarter every other sale? I don't know. If I were the manager in the store, I'd be more concerned about the cash being over, because my concern would be you shortchanged a customer. And I think that has more of a lot, for me, that has more of a long run implication, because then you've got customers who are unhappy, right? Which means maybe they don't come back to the store. So again, there's not really a right or wrong answer. And in my experience, many stores that are concerned about this, that have maybe a bigger profile store, will have a policy about how much is acceptable. But if I were the manager, I'd be more concerned about too much cash rather than not enough cash. I believe I said this last week. We talked about what it means to be material, and normally we say material is more than 5% of the total. So $28 out of $83,000 is clearly not a material amount. But our accounting requirements are, it automatically is considered material if we think it's a result of fraud or theft. And so even if it's a very small amount, if we think it represents someone stealing from the company, and in the case of a publicly traded company, that means you're stealing from the stockholders, that definitely becomes a concern for us, even if it's only $28. And that's why many companies will have a very clear policy about what's acceptable and what's not, in terms of the amount your register can be on. Okay. So that's the cash short and over account. We know that not everyone's perfect. We know that there will be differences between the cash collected and the sales that are reported. We use the cash short and over to balance that entry. The debits and credits that go into that account are going to somewhat offset each other throughout the month. And at the end of the month, we look at, okay, what's the balance in that account? And then we need to, excuse me, do an adjusting entry to zero out that account. If it's a debit balance, it's treated as an expense, a miscellaneous expense. So if we had a debit, let's say this was the only entry during the period. And so we get to the end of the month and we have a $28 debit balance in cash short and over. The adjusting entry would be to credit cash short and over $28 to zero it out and debit miscellaneous expense. If the ending balance in cash short and over was a credit balance, that's like a revenue. And so to close that, to adjust that, we would debit cash short and over to zero it and credit that other income. So we don't want to move it to sales. but we would credit it to other income instead. Okay, any questions about that? So that's one check and balance we have for our internal controls for cash. I am skipping over quite a bit, quite a few slides here in the PowerPoint. I'm skipping over quite a few slides that deal with other ways that we can receive cash through EFT, through vouchers, and so on. I would encourage you to read those in your textbook. I don't have anything to add to what's already in the book. And so I would ask you to make sure you read that. If you do have any questions, as always, just make sure you ask about them. But I don't have anything to add. I don't feel the need to read to you what's in the PowerPoint. If you want to see the summary, remember you do have access to these PowerPoints and you can just read through it that way, in addition to what's in the book. And so we said, as we move ahead, questions, anybody? No, I'm not trying to gloss over questions. So as we move ahead then, our next exercise is going to be related to bank reconciliations. Now, I have children myself who are roughly in the same age bracket as most of you. They are all somewhat recent college graduates, some more recent than others. But in the last five years, all of my children have graduated from college, maybe 6 years. Yeah, 5.5 2 years. And if you ask my children if they write checks, they will mostly tell you no. My one child, my youngest, probably has never written a check in his life. My oldest child, I think, has written 2, maybe 3. And my middle child probably writes checks more than the others because he has a specific thing that he writes checks for regularly. But other than that, they don't tend to write a lot of checks. I understand that. If they're not writing checks, if they're doing everything using a debit card or cash, then they're also not doing the personal equivalent of a bank reconciliation. And I imagine, I'm not asking for personal information from many of you, but I imagine that it's the same for you all. If you want to know how much is in your bank, you open the app on your phone and see what the bank says you have. I'm going to suggest that's not the best plan, but I also recognize it's the reality of the world in which we live, that is how people do business. And if you're not writing checks, then you don't have to worry about, I wrote a check, but it hasn't cashed yet. So the need for a bank reconciliation on a personal level is a little bit less than it used to be when you found out how much you had in your bank account once a month when they mailed you your statement, and you would check that statement against what you had in your check register. I understand it's a different world. The reason I would encourage you to keep maybe a better eye on that is because banks can make mistakes. Banks are run by humans, even though it seems like a lot of it is happening automatically or electronically. There are still human interaction, and sometimes even if it's done by a computer, the computer can misread your handwritten, when you do like a mobile deposit or something like that. You just want to make sure that those are happening correctly. I have seen it happen that the bank makes a mistake like, I don't know, putting your deposit in someone else's account. So you just want to maybe keep a closer eye on that. But for a business, it's even more important, because what you choose to do with your personal account is totally up to you, and it only harms you if something goes awry. If you are a business and you have a fiduciary responsibility to your stockholders to protect the assets of the company, you then have an obligation to make sure that your records match up with the bank's. So that visual I had up on the screen a few minutes ago that showed the flow of all of the information, one of the important steps is making sure that the bank's records match your records, or that you can account for any differences. So the next exercise we're going to look at is a very simple, very simplified version of a bank reconciliation. All companies need to be doing a bank reconciliation on a regular basis. For most companies, that means once a month. That you access the statement from the bank and you match it up with your internal records. And there will definitely be differences. Some of those differences are on the part of the bank. Some of the differences are in your own records. If the differences are in your own records, as we'll see in this next exercise, we need to make an entry for those differences. Okay. So banks provide a very useful function, a store of our resources, a way of keeping them safe. Bank accounts are insured up to, I think the current number is $250,000. There are two different institutions at the federal level that insure those deposits. There's one that insures banks, and then there's another one that insures credit unions. So you can have up to $250,000. It can be multiple accounts or just one account, but it's per banking institution. It is not per account. So if your company does routinely have more than that amount in its bank accounts, you probably want to be using separate, maybe separate banks to make sure that your deposits are fully insured. So you can have, up to $250,000 per bank, not per account. And so we get that bank statement, and this is in case you haven't seen one, and it's possible you haven't, because most banks at this point would prefer that you did not get a paper statement, and there may be banks that don't even offer you a paper statement. So the bank statement looks very much like what you see here. It would come out on a monthly basis. So this one is from the end of June to the end of July. It shows a summary of what you had at the beginning of the month, how much you put in, how much you took out, any other transactions that affected your balance, and then the ending balance. And then you see the detail. You can see all of the checks that cleared, or any deposits that you made would show up on here. They may appear in date order like this. There's usually, if there's a break in the check numbers. So if you look here, so we have 850, 851, 2, 3, 4, 5, 6, 7. So you'll notice that they're not in numerical order, because they appear in chronological order, the order in which they were presented for payment or cashed through the bank. So usually there is a spot on the statement that somehow indicates if there's a break in the sequence. So if a number is missing, so if you've written a check, sent a check to a supplier or something like that, and it hasn't been cashed, that would be readily apparent on your checking account. That's going to be a difference between what you have in your records. Your company records show that that check has been written and it's already been removed, credited to the cash account, but the bank doesn't know about it yet. Most of the differences on the bank side are going to be something that we already know about, we've put in our records, but it hasn't hit the bank's records yet, either because, as I said, that check hasn't been cashed yet, or maybe we've processed a deposit that the bank hasn't added to our account yet. So those are the primary differences you're going to see on the bank side. And if I can just skip ahead here, give me 1 second to find. Okay. So this is a brief example of what the bank reconciliation would look like. And you can see that there are two parts to it. One part is, this is what the bank shows, and one part is, this is what our company records show. And so we start with, this is what the bank said on our statement that we had. So we take that ending balance, and then we may have some additional changes that, again, things we knew about that the bank hasn't yet caught up with us. So a deposit that we've already recorded, but the bank hasn't yet added to our account, that's referred to as a deposit in transit. Doesn't truly mean necessarily that it's in a vehicle on its way to the bank, but banks, as you may be aware, close of business usually earlier in the day than their actual closing time. In my experience, credit unions do not work in that same way. So if you do use a credit union, you may not be familiar with that. But if you go into a bank at 3 p.m., there's frequently a sign that says this teller's on next day's business or something to that effect. What that means is the deposit that you give them after 3 o'clock isn't going to show up on that day's records. And so if your bank statement is closing, if it's the end of the month, then that's not going to show up on your bank statement either. We also have, as you know, those adjustments for checks that we've written but haven't yet been cashed. For our purposes, for the exercise we're going to look at in a moment, exercise 6, this outstanding checks is going to be a summary number. In reality, we would have a listing of every check that we've written that is still outstanding. Check number, the date, maybe, depending on how detailed we get, maybe the payee, the person we gave the check, and the dollar amount. That's really important that we're keeping track of how old are those checks. We refer to them as stale checks when they get past a certain date. I had a very interesting thing happen at my house. I think it's interesting. It's related to this. Over the weekend, my mother-in-law died in 2015. My father-in-law died in 2017. My husband was the executor for their estate. And just last week, we got a check from their bank for $8.21 because they just discovered that they'd made an error in accounting for their records. So the accounts were closed in 2017 and they're just catching up with it now for $8.21. As I said, banks do make mistakes. It's odd that it took 4 years to catch up with it, but that's something that if we were doing this bank reconciliation process, we may have caught. Now, in my defense, because I helped with their finances at the end, it was an error in calculating the interest that they had earned on a specific account. So it's not something we could have caught, because the only way you know about the interest is they tell you, here's how much interest you've earned. As I said, the bank statement part is, we start with, what did the bank say we have? Okay, here's the other things we already know about. The entries that are here, deposits in transit, outstanding checks, that information is not something we're going to need to make any changes in our records. That's information that's already in our records and the bank doesn't have it in theirs. The reason I brought up that check from that local bank for my in-laws is it said on the check that it had to be cashed in 90 days. After 90 days, that's considered a stale check. The bank's not going to honor it. They're not going to allow it to be cashed, and they're going to be able to reconcile that in their records as well. So that's why it's important for these outstanding checks to keep track of the date. Usually the check number, the dollar amount, the payee. In case you're wondering, I did make sure my husband communicated to his brothers that we now owe him each of them $2.05. Kind of crazy. $8.21 4 years later. What I didn't pay attention to was whether they were paying us interest on that interest. Because really, honestly, they should have been paying extra interest on that for the past 4 years since those accounts were closed. The bottom part of this bank reconciliation is our records, our company's records. And so it starts with, what does our general ledger say we have in that cash account? And then we may have some adjustments for information the bank had that we did not yet have. So what kinds of things could be there? Well, it could be that the bank collected on something on our behalf. And so they've made deposits into our account that we learn because we get the bank statement. We go through it line by line. It could be that they've charged us service charges, charged us for accepting checks with insufficient funds. So if someone writes us a check, it bounces, to use the colloquial term. It bounces. The bank not only charges the person who bounces the check, but they also charge the company that, or the entity that accepted that check that did not clear. So those are the kinds of things that are going to show up in our section, and those would then would require a journal entry so that our records will then match the bank as far as those items go. So there could be additions or subtractions on both the bank side and the company side. And as you can see here, at the end of the reconciliation, to say that we are fully reconciled, the adjusted bank balance must be exactly the same as the adjusted company balance. And then we're going to make those journal entries so that the company's balance matches this. We don't have to do anything with the bank side because that's information that we already have in our records. The bank will catch up with us as they process those deposits, as they cash those outstanding checks. Let's go to our next exercise, which is exercise 6. And you can see the format here. You can see the format here is similar to what we just saw. We have the section for the bank information. We have the section for the company information. As we always do with a report or a financial statement, we have a heading that says this is what you're looking at. Name of the company, name of the statement or report. This is a report, not a financial statement. And then the date. Okay, so this is as of the end of August. This is based on the information for the month of August. Number 1 says the cash balance according to the company's records at the end of August was $42,920. Now these are rounded off. We would not necessarily round. I would not encourage rounding in our company records. The records are most likely going to be accurate to the penny, and then we'll round for publication purposes. As you've already seen in the company that you chose for your annual report project this semester, their records are likely rounded to the nearest 1,000. But the actual records they keep inside the company are to the penny. We got the bank statement dated August 31st. It's probably received a few days after that. It's possible that we could be accessing that statement online and we could get it on September 1st, the very next day. But if we're waiting for a paper copy to come in the mail, there's likely going to be a little bit of a delay there. And so this bank reconciliation is not happening on the exact day that the bank closes that period, that accounting period. It is also possible that the bank statement might not be dated the last day of the month. So we're trying to reconcile our records for the month of August. The bank statement could be dated August 21st. And that's okay, that's fine, but we're just going to have a bigger section of reconciling items because we've got 10 more days of business after that statement came out. Ideally, then, we would be doing the reconciling for the same period that the bank statement covers. It will make it easier for us in the long run. And so as of right now, before we start looking for reconciling items, we're off by $14,000 almost. That seems like a pretty big deal. But as we look at the various items here, you'll see that we're able to explain that entire difference. At least we better be able to. The next information we're given is we have outstanding checks of $25,390. So as I said, even though we're looking at a summary there, that's not just one check for $25,000. We would have a listing, a detailed listing of what makes up that $25,000. What are the dates, the amounts of those checks? Who are the payees? Are any of them stale? Do we need to be calling our supplier and say, hey, we sent you a payment 3 weeks ago. I noticed the check hasn't cashed. Did you get that? Because sometimes things do get lost in the mail if that is how it was sent. So we might need to do some follow-up there. So these checks outstanding, those are amounts that the company, Creative Design Company, we have already subtracted from our register, but the bank didn't know about them yet. I'm going to show this as a negative just to remind us that that needs to be subtracted. So those are checks that we know we wrote. We already deducted it from our balance, but the bank just doesn't know about them yet because they haven't yet been presented to be cashed, to clear our bank. There's also a deposit in transit. I've already suggested how that could happen, that we put it in our records, but the money, for whatever reason, has not yet showed up on the day of the statement. So maybe we took it after 3 p.m. Or maybe it's the deposit, as we were hearing from one of you last week, the deposits for that student's company are counted the next morning. And so the sales might be reported on August 31st, but the money doesn't actually go to the bank until September 1st, but we've already reported it in our records dated August 31st because that's when the sales took place. Okay, so that deposit in transit is already in our total, but hasn't yet been added by the bank. And so we're going to add that here. So we're just going to find a total here. And I get a revised or an adjusted bank balance of $44,235. And so basically what we're saying there is if the bank knew everything we knew, if they knew about all those checks that we had written that have not yet been cashed, if they knew about that deposit that we've already reported in our books, but they haven't reported in theirs because of a timing difference, if they knew all that stuff, they would have said our balance is $44,235. And so we know that what we're going for then is for our company's adjusted balance to also be $44,235. And so let's see if we can get there. A check for $150 in payment of an account was erroneously recorded in the check register as $1,500. So we overstated in our records, we overstated our account. A customer paid us $150. We reported that we were paid $1,500. We talked about in a couple chapters ago, maybe chapter 3, about fixing errors in our accounting records. We talked about 2 different ways we can do that. And we talked about 2 different ways of fixing that error. For our purposes here on the bank reconciliation, we just need to include the total difference. And so our cash is overstated by $1,350, the difference between the $150 we actually received and the $1,500 that we recorded. So we're going to have to subtract that. And then we will need to make an entry to correct that. And it's not enough just to know that it happened. We need to actually fix it in our records once we're done with this reconciliation. The bank also hit us with service charges. And I'm sure we knew the service charges were a possibility, or maybe it's something we see in our records every month. Maybe it's because they collected something on our behalf. Maybe it's an NSF check, an insufficient funds check. Maybe they printed some new checks for us. I don't know. Doesn't tell us what the service charge was for. Maybe it's just for the privilege. Oh, I apologize. I need to go back here. Because I had limited information, I misunderstood. I thought it was us making the payment, but apparently it was us receiving the. Hang on. I'm unclear in this number 5, whether we are paying or we are receiving. But given the options that we have here in these drop-down menus, I'm gonna have to change what I said about that because it doesn't give us the option that I was looking for. So it must be that this isn't a check that we paid out. It was a check that someone paid us. No, wait, hang on, let me think about this. Because it doesn't say there, and I'm trying to think what it must be based on the words they've given us. I chose the wrong one. Okay. So if we're adding this, which is the only way it's going to make sense in our so this must be something that we paid, not something that we received. Okay. If you're looking at this saying, well, if she doesn't know, how are we supposed to know? My answer is, if we worked for this company, we would know. Is this something we paid or something we received? This is worded very ambiguously, meaning when we read this, it doesn't tell us whether we paid it or we received it. It wouldn't be that vague, because if you worked for this company, you would actually be able to identify that. Now, how would they find this? On that bank statement, I go back to that here. On that bank statement, it tells us how much each check was. The way we would find that error is the amount that showed up on this bank statement would not match the amount in our records. It is a very tedious process because it requires checking carefully every single one of these checks to make sure that the amount matches. And I think I may have even told you the story about my father-in-law writing a check that the amount he wrote the check for is how much my brother-in-law cashed the check for. It was a Christmas gift. And that's not the amount that the bank actually took out of his account. It's really important that you pay very close attention to that you're matching what's in your records to what's on the bank statement. In that case, the check had cashed, but they cashed it for the wrong, they recorded the wrong amount on his bank statement. They took the wrong amount out of his account. Clearly that can happen. It's unusual, but it can happen. As I said, as I read this, the part I have highlighted, it does not say whether we are receiving or paying, and I made the opposite assumption, but if we were really this company, Creative Design, there wouldn't be a question because we would be looking at the bank statement. It would be very clear, was this a deposit or was it a withdrawal, a check that was cashed? So I apologize that I misread that, but there really is no way reading this to know which one it was. Were we receiving or paying? The only reason I know that is because it didn't give me the option of deducting a bank service charge on this top line. But as you know, in the real world, nobody hands you a template like this with only choose from these options, right? We would be filling that in by hand, basically. So if we add all these, add and subtract here, let's see if we come up with that same number. The number we know we are looking for, 44,235, because they have to match, and it does. Any questions about this bank reconciliation? Again, it's a condensed version because we would need to know the details of these outstanding checks to be able to follow up as needed. And then, as I've already indicated, we would do journal entries to fix these two items that are in our reconciliation. So what would we be doing? Well, we were adding that cash back. So the first entry would be because we wrote a check for $150, but we accidentally recorded it as $1,500. So we need to add back that cash. And it said it was for a payment on account. And so we're also going to add it back to accounts payable. If we looked at accounts payable at that point, it would look like we overpaid some account, some supplier, overpaid by $1,350. Now, hearkening back to chapter 3, we said there are two ways you could make that change. You could reverse the entry that was wrong and then put in the correct entry. That's the two-step process. What I've done here is the one-step process for fixing that error. Then for the second one, this is a charge that the bank, it's an expense, the bank charged us for something. And so this would be not a correction, but it would be a transaction that we're recording. We just didn't know about it until we got the statement from the bank. And as I said, maybe these are service fees that they charge us every month, but we don't know how much the amount is until the statement comes. Could be. So we make those two entries to our records so that our records now show a balance of $44,235. It was $42,920 when we started this reconciliation process, but after we make these two entries, we add $1,350 and subtract $35 from our cash. Our new balance is $44,235. That is the correct balance, and that is how much we would. That is how much we would report on our balance sheet as of August 31st. The updated, the correct balance. Now, with everything we've talked about, what do you think the answer to letter C is? Must a bank reconciliation always balance? Yes. The answer is definitely yes. Sometimes it might be a multi-day process because there's something crazy that you're just not picking up, like that situation that I already suggested. That the check, the amount on the check didn't match, and sometimes that might be hard to pick up. All right, so that's the bank reconciliation process, a very important part of internal controls of protecting our cash, making sure that the cash that's deposited matches with what's in our records, making sure the bank hasn't made any errors, updating our accounts with any additional information needed for from the information that the bank provided. I just showed you what these entries should look like, and I probably should have left them on the screen. I apologize, but this is the same information. This is the same exercise. We've already done the bank reconciliation, and now you need to do the journal entries to record the two things that the bank knew that we didn't know. So go ahead and put those entries in. Again, I already put them on the screen and talked about what they would look like. So I called it bank service fees. They're calling it miscellaneous expense. I think we've talked about that before. If it's something that's not frequently occurring or not a very large amount, if we only have bank fees once a month and they're $35, it doesn't make any sense to have a separate account for that very small and not very frequently occurring cost. And so we're just lumping it into miscellaneous. So we'd already talked about that. Any questions about that though? Again, anything that appears in that bottom section where we're reconciling the company's books, we then need to make sure that we get those into our records, because otherwise what happens next month? Next month, we would start with that $44,235, which is not actually what was in our records. And it will be a nightmare to try to figure out why we can't get our books to balance. And the reason would be because we never made the adjustments or the corrections from last month's bank reconciliation. We need to make sure we're updating that balance in our books. Questions, anybody, before we keep going? Okay. So let's move on. Banks will sometimes act as a collecting agent, meaning that they will collect something, they will receive a payment from a customer on our behalf. We have a chapter coming up. Is it the next chapter? Yes, it's our next chapter. Sorry, sometimes I forget which order these chapters go in. So remember I told you that it used to be in most accounting textbooks, there was one chapter called cash and receivables, and internal controls was just kind of a little piece of that. Receivables now has its own separate chapter, and I sometimes forget in which order they appear. So that is our very next chapter on receivables. And in that chapter, we'll be talking a little bit more about what this means, that there was a note. We will talk about notes receivable in chapter 8. We will talk about notes payable in chapter 10 and maybe a tiny bit in chapter 11 as well. We know what receivable means. Receivable means someone owes us, right? And payable means someone that we owe someone outside the company. If the bank is collecting on a note for us, what that means is we have in our records a note receivable that someone, a customer of ours, owes us money, and the customer has agreed to pay on a given date a certain amount. The amount that would be paid would be the amount that was borrowed, in this case $20,000, that's known as the principal, as well as the interest. So what makes a note receivable different than an account receivable is that interest. And so in the next chapter, we'll learn how to calculate that interest, and we'll talk a little bit more about this process. But what this means is a customer borrowed $20,000 from us. Does it mean that we actually wrote the customer a $20,000 check? Probably not, unless we're a lending institution like a bank. What it more likely means is that our customer owed us $20 on an account and bought something from us on credit and needed some extended time to pay. And so we said, sure, you can have more time to pay. Maybe the original payment terms were net 30. And during that 30-day period, the company knew that they wouldn't be able to pay us. And so they said, could we just have a little bit longer? We'll pay you interest, so we'll compensate you for the time. And we said, sure. And so we agreed to terms. We wrote up a note, which is literally a document that says, here's how much you're borrowing, here's the interest rate, here's how much you're going to owe us, here's when it's due. And the borrower, the maker of the note, signs the note and says, it's known as a promissory note. So if you ever played the game of life, you may have seen that term promissory note as part of the game of life. That's what we're talking about here. We usually just call it a note, but it is a promissory note. It's a promise to pay later a certain amount with interest on a certain date. We'll talk more about that in chapter 8. How it's relevant here in our cash and internal controls is the bank has collected on that note for us. So we told the customer, just take, take the check for $21,200 to the bank and they'll put it in our account for us. And so the bank told us, Borden Company told us, we collected on that note for you, and we said, cool. But as you can see here, we have not yet made the entry. So it may be that the way we found out is it was on our bank statement that showed they had collected it for us. It may be that they notified us in a separate letter, and now we're making that entry. And so here's what needs to happen. We have $21,200 in cash in our bank account that we did not have before. The bank accepted it on our behalf and put it into our account. So to make our records match the bank's, to match reality, we need to reflect that we have that cash. But where did it come from? Well, we said that the maker of the note, the company or the entity, our customer that did the borrowing, had borrowed $20,000. So at the time that the money was borrowed, whether the sale was made on credit or we converted an account receivable into a note receivable, at that time on our balance sheet, we showed, hey, Joe Smith owes us $20,000. We set up a note receivable for $20,000. That is an asset. Depending on when it's due, it could be a current asset or an investment, a long-term asset. If it's due within 1 year, it's a current asset. If it's due, if we give them more than 1 year to pay, it would be a long-term asset. We would call that an investment. And so that was what has been on our balance sheet. Hey, Joe owes us $20,000. And now since Joe's paid us, we're going to remove that. We're going to credit that note receivable. The other $1,200 represents interest, and that's interest revenue that we're going to record at the same time we record the receipt. Now, if that interest was earned across 2 periods, so maybe if we follow the calendar year as our fiscal year, this goes beyond what's in the exercise. In case you're wondering where is she getting this from, I'm making this up. Let's say they borrowed the money in November and they paid us back in February. Well, at the end of December, we would accrue some interest. And we talked about in chapter 3 what that interest accrual would look like. In this case, we're assuming this happened all in 1 fiscal year because we had not accrued any of the interest. But once we make this entry, our books will now be accurate and up to date as far as that piece is concerned. The bank account will correctly reflect the cash that we have. Our balance sheet will no longer show that Joe owes us $20,000, and our income statement will show that we've earned $1,200 in interest revenue or interest income. All right, so that's one thing that might come out of this bank reconciliation process, that we become aware that they collected for us on some note that was outstanding. Before I got married, I lived in an apartment for a short time. And the deal with my landlord was she just gave me a stack of deposit slips with her bank account information. And so every month to pay my rent, I just had to take my check to the bank with her, to her bank with one of those deposit slips and deposit it in the account. How did she know that I had paid it? Because she got the report from the bank that showed those deposits. And so she would have had to do something similar to what I just described there when she did her bank reconciliation. And I wasn't her only renter, and so she would have been doing that same entry for all of the people who were renting from her. Okay, moving on then. For those of you who are not in the classroom, you're not seeing what we are seeing, which is, daylight savings time happened on Saturday night, Sunday morning, and most of the clocks in this building are tied into the system. So you don't adjust them manually. And so what they do is they just shut the system off and then they restart it when it hits the right time. So I keep looking at the clock and I'm really only looking at the second or the minute hand. And I'm trying to remind myself to look at the computer so that I know how much time we actually have left. The clock, in case you're wondering, says it's 12:28. It's not very helpful. Let's look at our next exercise. So we've been talking about this whole chapter, the importance of internal controls to protect the integrity, to protect the assets of the company, and cash is, of course, one of those vulnerable assets. So let's take a look at exercise 9, using bank reconciliation to determine cash receipts stolen. And I will say up front that this person, the sales clerk who stole this, was not very bright about the way they went about this. I'm not suggesting there's a good way to steal money from your place of work, but the sales clerk was the person responsible for taking the daily deposits to the bank, that the clerk was reporting the correct amount in the records and then not depositing the whole amount. So you'd think you'd be consistent, right? If you're not going to deposit the money, you also wouldn't report that you had the money, but whatever. Again, I'm not suggesting there's a good way to go about stealing, but this was a bad way. Alaska Impressions Company records all cash receipts on the basis of its cash register tapes. We've already talked about what that would look like. We've seen the use of cash short and over. We credit revenues for the amount on the cash register tapes. We debit cash for the amount on the that we actually are depositing. And then the cash short and over would make up the difference, whatever difference there was between those two numbers. Alaska Impressions discovered during October 2013 that one of its sales clerks had stolen an undetermined amount of cash receipts by taking the daily deposits to the bank. The following data have been gathered for October. No deposits were in transit. Determine the amount of cash receipts stolen by the sales clerk. And so what we're going to do in a very informal way is set up kind of a bank reconciliation and see what we come up with. So we start with the bank balance. So the second line says cash according to the October 31st, 2013 bank statement. It tells us there are not any deposits in transit, but we do have some outstanding checks. And so we're going to need to subtract those. Those are amounts that we know will be coming out of our account. And so we have an adjusted bank balance. Of 9605. So if the bank knew what we knew, if the bank knew everything we knew, they would have set our balance, or the statement would have shown 9605. And then we're going to look at what our books say. So our balance, so we're going to call it the general ledger balance, was $11,680. It tells us the bank collected, I'm looking at the last line, the bank collected a note receivable including interest. This is what we just saw in the previous exercise. So we're going to add that note plus the interest. And then the bank also charges a service charge that we need to subtract. Go back to the calculator. And once we take into account those two things that we learned from the bank statement that we did not know, they collected the $2,100 on a note for us, but they also charged us $40 as a service charge for something. And so the adjusted balance in our general ledger is $13,740. $13,740 is how much our books say we should have, but the bank says, yeah, but you only have 9605. So the difference between those, $4,135, is the amount that is unaccounted for, that is missing at the moment. So our final question here, what accounting controls would have prevented or detected this theft? So what do we say was the problem? We've got the same person counting the money, depositing the money. There aren't two sets of hands on that. And so separation of duties would have helped with this. Now, it was detected because they do the bank reconciliation and they discovered that the numbers didn't match. I had suggested that the clerk should have, if the clerk was responsible for doing both parts of this, you'd think the clerk would have not recorded all of those revenues. But that's why having the cash register tapes as the documentation for your revenues is important. This is why companies analyze, use data that they have access to analyze the different types of, or the different people who have their hands on the cash to see if they can detect any trends that are just that are potentially dangerous. So what are they looking for specifically? Different, something that makes one cashier's results look different than the average cashier. So maybe one cashier has a large number of voids. Maybe one cashier accepts a higher number of coupons than average, or it processes more returns than average. Those are the kind of things that throw up at least yellow flags. Hey, we might want to look at that. Why is it that Susie takes more coupons from customers than a typical cashier? And maybe that Susie's just really good about pointing out to customers, hey, you know, there was a coupon for that in the ad this week. Why don't you tear one out there? But what else could be happening? Susie runs brings up the order, and then after the customer has paid the full amount, Susie slips a coupon into the register for $1 off something and takes $1 out of the drawer. And Susie might even justify that with, well, yeah, but the company's still going to get the $1. They're going to redeem that coupon, and they're going to get the $1 plus the cents of handling charge. So I'm not really stealing. Of course, that's not true. Absolutely, that is theft, fraud. So having those separation of duties may have helped this from not happening or being detected more quickly. Any questions about that? All right, let's move on to our last exercise here. We have 7 minutes left, so I want to make sure we get through this to end this chapter. And we're going to move on to a petty cash fund. You may also see this spelled in its original spelling. You don't see that very often anymore, but the original was petty cash. That is the French word for small. The petty cash fund is a small amount of money that the company has literally on hand in cash to cover miscellaneous type expenses. So someone needs to run over to Staples to grab some note paper, or you've run out of dry erase markers. I had that happen here once. There weren't any good dry erase markers, and God bless her, Emily said, I'll just run over to Paper Factory, which is right around the corner from our location here in Olean. I'll just run over to Paper Factory and get you some. No, you won't. I can do without, but I'm kind of funny when I'm not teaching on Zoom, when I can actually use the whiteboard. I'm kind of funny about my markers have to be dark. So that would have been a good use of petty cash funds. So the idea of a petty cash fund is there is a custodian, there's one person, you want to control access to that cash, because again, cash is a vulnerable asset. So there's one person who's in charge of the petty cash fund, and he or she has that actual cash in a locked location that only he or she has access to. And as people need to access that petty cash, this is what might happen. They come to the petty cash custodian, they request $20 because they're going to run next door to get some supplies. And so they write out a receipt. The petty cash custodian writes out a receipt for the $20. And then the person brings back the supplies and the change is put back into the box along with the receipt for the $12.74 that was spent or whatever. It's used for small amounts where it doesn't make sense, where there's a more immediate need. You don't want to wait for a check to be cut, or it's a small amount and it doesn't make sense to write a check for it. And so let's walk through this in our exercise for what this would look like. Not all companies have a petty cash fund. How much is in there, how much is considered small, is dependent on the size of the company. So a very small company might have $100 in their petty cash account, where another company of considerable size or considerable more need for it might have hundreds of dollars in that petty cash fund or even more. But that term petty or small is relative to the size and the needs of the specific company. So in this exercise, letter A tells us a check was issued to establish a petty cash fund. And so they would decide who the custodian of that petty cash is. The custodian has that $500 check. The check is actually cashed. And, so now we have small bills and change. In that, I'm picturing a locked box that's going to be kept in a locked drawer or cabinet. On our balance sheet, we move the $500 out of the cash account into the petty cash account, just to keep it separate. Now that petty cash is still part of the cash and cash equivalents. You're not going to see a line for petty cash on a company's balance sheet. It's a small amount. We're not going to report it separately. But then throughout the period, throughout the month, as we're using that petty cash account, I've already explained, described how that might happen. Receipts are put into the box, and the person who made the expenditure is being reimbursed for those expenses. The business is going to decide how often to replenish that petty cash fund. It may happen automatically at the end of each month. It may be that you only do it when the petty cash reaches a certain critical level. So if this is a $500 petty cash fund, maybe they say once it gets below 50, we're going to replenish it. Or at the end of the month, we're going to replenish it, or both, whichever comes first, right? And so at the end of the month, what they're going to do is determine how much is missing, or has been not missing, how much has been used from that petty cash fund, and they're going to replenish, bring it back up to the full $500 amount. So letter B, it says the amount of cash in the petty cash fund is now $40. And so they're going to request a reimbursement for $460 to get it back up to the level that it needs to be, the $500. You'll notice the petty cash fund still says it had $500 in it, even though we've been spending money. But when we request that amount to be replenished, we're then going to record those other things that happened. We're going to record as expense, or in the case of this office supplies, we're going to record the acquisition of that asset. So what did we get for our $460? Well, we got $212 worth of office supplies. In chapter 3, we talked about where, how that would be done. We have miscellaneous selling expense of $156, miscellaneous administrative expense of $61. And now I'm just going to add up the debits we have there. That only adds up to $429, but we're requesting a reimbursement of $460. We're off by $31. Where did that $31 come? Where did it go? Right? It came out of the box. It's no longer in the petty cash, but we don't have a receipt for it. I don't know what happened to it. Now, if it's a material amount, we're going to be worried about it. But if it's a small amount, we're going to assume it's just, well, a receipt got missed, you know, we lost one. We're not going to be too worried about it as long as it's a small amount, unless we think that someone is trying to steal or defraud the company. Otherwise, we would just use that cash short and over account that we already talked about earlier in class today. And it's just going to get rolled into that debit and credit combination at the end of the month. So as we reimburse the petty cash fund, just to finish up here because we're out of time, you'll notice the actual petty cash fund is not affected. When we set up this entry right here in letter A, we said there's $500 in the petty cash fund, and it shows that there's $500 in there the whole time. In a perfect world, the combination of the receipts that are accounted for and the cash in the box would always add up to $500. But as you can see, we were off by a little bit. I don't know, maybe someone had pizzas delivered and they took money out of the box to tip the delivery guy. I don't know. We're not really worried about a small amount of money unless it hits that materiality threshold, more than 5% of the total, or we think it's as an attempt to defraud the company, to steal from the company. And we are over 1 minute and we are finished with the chapter. Does anyone have any questions or anything else you want to talk about at this point? Okay, so if you're available and think it would be useful, please do consider signing up for that drop-in review session for Friday. If there's something specific you want to talk about at that you think would be particularly helpful, send me an email and let me know that. All right. Okay. See you Wednesday.